Hey everybody, Smart Silver Stacker here. Welcome to another live stream. Today, we're going to discuss what may be the trigger for the next phase of the banking crisis that we have been watching play out for the better part of a year. The regional banking crisis that began in the U.S. last March with the collapse of Silicon Valley Bank, First Republic Bank, Signature Bank, and today it is continuing with the collapse, or what may very well be the collapse, of New York Community Bank Corp. This is the entity that took on the troubled assets of Signature Bank. Now, the reason we need to watch this is because this is now showing signs of spreading around the world, and this time it's not being triggered by the treasuries on the bank's balance sheet. No, it's being triggered by their exposure to commercial real estate. But all of this is related to the Fed's campaign of rate hikes in this debt-addicted economy in which we are operating. And when the magnitude of this crisis becomes apparent, it's going to have a huge impact on Fed policy and also very likely on the physical gold and silver market. So we're going to talk about all of that in today's video. Starting off with this development from February 6th, this from Bloomberg, NYCB, that's New York Community Bank Corp, the bank I was just talking about, their credit grade has been cut to junk by Moody's. Moody's tells us that the bank is facing multifaceted financial risks and governance challenges, which lowers the company's long-term issuer rate by 2 notches below investment grade to Ba2. The ratings firm said it could go further if conditions deteriorate. They go on to say that long simmering concerns that a slump in commercial property values could hurt U.S. regional banks. These have intensified in recent days as lenders from Frankfurt to Tokyo signal strains in their own portfolios. Behind it all is a pandemic-induced shift to remote work, stricter rules for raising apartment rents in some markets, and here's the important part, a run-up in interest rates that make it more expensive for strained borrowers to refinance. So it's kind of a perfect storm here for commercial real estate. You do have office vacancies on the rise. This has been a trend since the pandemic, since people began transitioning to work from home, but also it's primarily the fact that the Fed is keeping interest rates higher. This is putting a lot of pressure on purchasers who can't secure financing at these higher rates. Now, we can take a look at the chart of New York Community Bank Corp. You can see today, once again, the bank falling under some pressure, down another close to 5% here at the moment. Now, it has rallied a bit from the lows of yesterday when the bank stock was tanking. It was down to about $3.68, but still just above $4. And you can see if we look at the longer-term chart here, the one-year chart, you can see this share price falling off of a cliff following the announcement of losses that they have taken on portions of their commercial real estate portfolio. You can also notice here that the price now is well below the lows from the crisis that we witnessed in regional banking last year. The share price was down around $6.50, down in the low sixes, but now it's down to under $4. It was under $4 yesterday. Now it's recovered a little bit, but I wouldn't be surprised if we see this share price tanking once again. Now this is interesting, and I want to kind of jog your memory here a little bit. This is a story that we got yesterday. Troubled lender NYCB seeks to reassure investors after stock slide in the Moody's credit downgrade. Where have we seen this before? I mean, just take a look at this article here. New York Community Bank Corp is attempting to reassure investors about its deposits, liquidity, and governance following a week-long purge in the company's stock and a decision by Moody's to cut the bank's credit rating to junk. The $116 billion commercial real estate lender put out a press release just before midnight Eastern Time on Tuesday following the Moody's downgrade, showing that total deposits were up since the end of 2023. Its total liquidity of $37.3 billion exceeded its level of uninsured deposits. So, yeah, according to the bank, sure, everything's fine over there, right? No problems at all. Now, what does this remind you of? Well, this is a story that was published on March 9th, just before the collapse of Silicon Valley Bank. Silicon Valley Bank CEO to investors, stay calm, don't panic. The boss of the 40-year-old financial firm, which saw its stock plummet 60% in afternoon trading on Thursday, gathered key venture capitalists and founders on a Thursday Zoom call to promise the bank is in a strong position with lots of liquidity. Now, to be fair, I mean, obviously that was not the case with Silicon Valley Bank. Perhaps it is the case with New York Community Bank Corp. But you can't really trust these institutions, obviously, when they tell you that everything is fine, right? I mean, it's their job to maintain confidence. They understand that once depositors and investors lose confidence, it is all over. Now, another thing that I am reminded of as I watch this crisis play out this time around is what we witnessed happen in the physical gold and silver markets last March. I've got the SD bullion page for junk silver pulled up here, and you can see right now junk silver selling for a little over $17 per $1 face. Do you remember what it was selling for in March and April of last year? The premiums on this stuff absolutely exploded. This is like the canary in the coal mine product. Right now, however, premiums are very low. So look, it's not financial advice. I'm not telling anybody what to do, but I have a forecast for you, and that is as we watch this banking crisis play out, we are going to see supplies of certain physical products, junk silver especially, going to dry up and the premiums are going to explode. That would not surprise me one bit. So, this might be something to consider stacking if you are in the market for physical silver. You can check out ST Bullion with the link in the description. Now, this is a chart of the Spider S&P Regional Banking ETF. So this is kind of an overview of the whole sector. You can see it, too, has come under some pressure following the announcement of those losses on the commercial real estate portfolio of NYCB, but we're still nowhere near the lows of where we reached during last year's crisis. And so, this can tell you a few things. Right now, everything is still, in the early phases. If this is a real crisis, there's still a lot of room to fall. However, it hasn't really begun to play out quite the way it did last year just yet. So we might still have some time to get prepared for this. Now, I also want to take a look at the chart of Wells Fargo, one of the large banks. And this is the big bank with one of the largest exposures to commercial real estate in its portfolio. But it's very interesting here. You can see it has really not come under much pressure at all in the most recent round of this bank crisis. A lot of the smaller bank stocks have come under some significant pressure. Wells Fargo is still doing just fine. Now, hey, I do see some folks in the chat here. Hey, Constitutional Stacker, how you doing? Welcome, everybody. Do me a favor. If you're tuning into this video, you find this information helpful, do me a favor, smash the like button. If you haven't subscribed to the channel yet, do that. Share the video on social media. I appreciate it. It's the biggest thing to help spread this information. It helps out the channel. I am eternally grateful to everybody who does that. Now, Wells Fargo, they are not collapsing. So why is that? Why is it that the regional small banks are coming under pressure? Well, the reason is that following the activity last year in the banking sector, basically what we've been told is that small regional banks may or may not be bailed out by the FDIC and by the Fed. If a bank is deemed not important for the systemic banking system. Systemic banking system. I mean, that doesn't make any sense. But if they're not deemed systemically important, let's say, they're not going to get a bailout. But major banks 100% will. That's why this isn't selling off. But this is a big problem because what this tells depositors is that their deposits will be safe at a too big to fail bank like Wells Fargo, but they may not be safe at a regional bank like NYCB. And that is the reason, potentially, that we will continue to see depositors from these smaller institutions as fear mounts, pulling their deposits, putting them into the big institutions. Of course, this fuels the crisis because the withdrawal of deposits from the small regional banks is very much what could force them to raise liquidity by selling assets like their devalued treasuries, like what we saw in last March, or in this case now, if they're forced to sell these commercial real estate assets that they have at fire sale prices to realize the losses, this could trigger a major crisis. So the fact that the too big to fail banks are doing just fine is actually a big problem here, and it could lead to a broader crisis. And I would not be shocked to witness that play out here. This is from Reuters from February 5th. U.S. regional lenders' commercial real estate exposure in spotlight after carnage. They're referring to the carnage at New York Community Bank Corp. And here's a list. You can see investors fear weak demand for offices could trigger a wave of defaults and put pressure on banks and other lenders which are hoping to avoid selling CRE loans at significant discounts. As I just mentioned, if they're forced to sell these and realize the losses on them, that could be what triggers the crisis. That's what triggered the crisis in Silicon Valley Bank last year. They weren't forced to sell commercial real estate assets, but they were forced to sell investments in treasuries that they had made. They were forced to realize a major loss on that. And so, this is all, again, related to the fact that the Fed has raised interest rates and kept them high. That's what's putting pressure on treasuries. That's what's putting pressure on commercial real estate, all these assets that these banks are holding. And you can see on this list from Reuters, this is a list of prominent regional banks with a lot of commercial real estate exposure. New York Community Bank Corp is at the top of the list here with $116 billion in assets, but there's several with quite significant exposures. Valley National Bank Corp with $61 billion, Columbia Banking Systems with $52, Bank OZK with $34, and you can see the commercial real estate concentration ratio here, which they say is refers to the extent of the bank's loan portfolio consists of commercial and multifamily mortgages, very high here for a number of these small regional banks. And this is a problem that is concentrated primarily in the regional banks. As I said, some of the majors like Wells Fargo also with exposure here, but it's a much bigger percentage of these regional banks' portfolios. And so that's likely where we're going to see the crisis play out. Now, the Fed, we're still anticipating that they're not going to cut rates here in March. That is, according to the CME FedWatch tool here, we're probably going to have to wait until May. At least that is what markets are currently pricing in. However, should something occur between now and the 20th of March, and certainly there's plenty of time for something to occur, we may see the odds of a March rate cut resume once again. I mean, the Fed has been doing their best to jawbone these markets, to convince markets that there's going to be more hawkish Fed policy. But right now, keep in mind, markets are only anticipating an 18.5% chance of cuts. If this goes up, or if the Fed does actually cut, you could see a huge turnaround. It would probably be a huge boost to U.S. markets in general, and also to the gold and silver market. Now, if the reason that they're forced to cut is because of a crisis, you can expect a lot of interest in physical metals. We already saw that last year, and I expect that this time around it could be even more significant because it's going to be harder to convince markets that everything is fine and that everything's under control if this contagion continues to manifest itself. And this is not a crisis solely related to the U.S. I mean, this is a global crisis. This is one from the Wall Street Journal from yesterday about how commercial real estate woes have now hit German banks. Bonds issued by Deutsche Pfandbrief Bank, I'm not sure if I'm saying that right, but they're a small property lender. They sold off on concerns that it will have to increase provisions to cover for a potential wave of defaults. So we're not only seeing this spread in New York Community Bank Corp, there are other banks that are already affected, and this is indicative of a bigger systemic problem. We're going to hear a lot about how this is concentrated to NYCB. It's only their problem, but clearly that's not the case. You got this bank in Germany that relies heavily on commercial real estate financing for earnings, the U.S. representing 15% of the bank's portfolio, according to S&P. Their bonds sold off from about 4%. The yield soared up to as high as 11%. So that's a huge sell-off in the debt of this bank. And then also you got this one from the Wall Street Journal from February 1st about how commercial property losses hammer banks on 3 continents. In this story, they talk about how a Tokyo-based bank, its shares fell more than 20%. That's the maximum allowed on a single day. So basically, there was like a market intervention there, a rule that stopped it from selling off more. They said that losses in its U.S. office loan portfolio will likely lead to a net loss for the year ending in March. In Switzerland, the bank Julius Baer said Chief Executive Philip Rickenbacker resigned after the company took a $700 million provision on loans it said it may not get back from an Austrian property landlord, Signacorp. So we're seeing a slowdown in commercial real estate, not just in the US, but globally, and it's having a huge impact on these banks. So what ties these banks together is that banks are big lenders to real estate owners and developers, putting them on the front line of the downturn in office building use and falling valuations. Now, why does all of this matter? Well, the only way that they're going to be able to resolve this problem for these banks is by slashing interest rates. They're going to have to do it because that's the only way to get buyers into this market when they can finance these purchases at low rates. I mean, all of the current mark-to-market or all of the current valuations on the balance sheets of these banks, I mean, they're not marking these properties to market, which would mean huge cuts. What they're doing is they're using the valuations from a time when rates were much lower, when a lot of these leases were signed. But the problem is now the leases are coming due, and it's going to be a huge problem as these properties need to be refinanced because the interest rates are much higher. So this is just another sign that regardless of where inflation goes, if the Fed and central banks around the world want to avoid a systemic financial system collapse, they're going to have to cut rates, and they're going to have to cut them soon. So, whether it comes in March or May, I don't think it's really too big of a deal. I think the big thing to note here is that once the cuts begin, they're probably going to be much bigger than anybody anticipates. And I wouldn't be surprised if we see the Fed getting right back into the market and purchasing U.S. Treasuries outright, ending QT, resuming QE to lower interest rates to bail out all of these banks from their Treasury portfolios, from their commercial real estate portfolios. All of it is related to the addiction of these institutions to easy money, the addiction that was created during a decade plus of record low interest rates kept near zero. Now the bubbles that those inflated are threatening to collapse. And, I don't know about you, but I have a hard time believing that during an election year, the Fed is going to allow these things to collapse and to pop. So probably a lot more money printing coming ahead than markets are anticipating. But for us stackers, I think that is going to be a good thing because it's going to mean a lot of money creation. And, it won't really be a good thing, I guess, for anybody in the economy to have the dollar eviscerated. But at least those of us with physical assets like physical gold and silver, like this junk silver from SD Bullion, will be insulated from the worst effects of it. Now, thank you, Constitutional Stacker, for the super chat. He says, I'm poor now, but why not? Well, I appreciate that, buddy. And times are tough for everybody, but Constitutional Stacker, I'm sure you are rich in terms of real hard assets, probably have quite a bit more of those than your average person. And when it becomes obvious what is coming for the dollar and for the Fed and for interest rates, I think a lot more people are going to be interested in getting into those, and it's going to mean a large amount of cash flowing into a very small market. So once that occurs, I'm sure there's going to be a lot of people out there complaining about the soaring premiums and the long ship times. Just remember that right now, in February of 2024 at least, you can still get physical bullion without a lot of premiums. In fact, premiums are down to the lowest I've seen in years. So not financial advice, not anything I'm telling anybody to do, just telling you what I'm looking at doing myself, and that is taking advantage of the situation where premiums are low and the spot price has dipped before that changes in a big way. So let me know what you think in the comments down below. Thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker out.